Welcome to the Deep Dive.
The show where we take the sources, filter out all the noise, and really give you the core insights.
And today we are strapping in for a deep dive into a really fascinating high-growth story in the Indian tech sector, AurionPro Solutions Limited.
That's right. And for anyone tracking this company, the headlines really only tell you half the story.
Right.
We've gone through the Q1 and Q2 earnings call transcripts for fiscal year 2026. The raw data.
So we can understand not just what they earned, but how they're positioning themselves for the future.
Exactly. Our mission today is to dissect their core product strategy, analyze their financial health, and really scrutinize the aggressive investment choices that are driving this trajectory.
So we're moving past the surface level stuff to really get under the hood. We'll walk you through their business model. We'll look at the P&L, the balance sheet, cash flow.
And then the efficiency metrics, and crucially, the risks that management has actually confirmed themselves.
For a company growing this fast, it's so important to separate that intentional strategic spending from, actual operational weakness.
That distinction is everything. It's where all the value is.
Absolutely. So, before we jump into the company's engine, a quick ask. If this kind of detailed analysis adds value to your research or your learning,
Please, take just a moment. Hit the like, share, and subscribe buttons.
and make sure to click that bell icon. That way you get notified for all of our future deep dives. We really appreciate the support.
Okay, let's unpack this. If you're new to AurionPro, the most important thing to know is this isn't the same company it was 5 years ago.
Not at all. They executed a massive pivot. I mean, they went from being a diversified IT services business.
Which is super competitive, low margin.
Exactly. And they shifted to become this specialized global products and platforms company. It's all rooted in depth R&D and engineering now.
And that pivot is really the core of their entire investment thesis.
It is. They now focus on two high-growth, very specialized segments. First up is banking and fintech.
The big one. The big one. Here, they're offering proprietary platforms for things like transaction banking and lending through their Integral platform. And, crucially, they're integrating enterprise AI in a big way after acquiring Aria.ai.
Okay, and the second segment?
That's the Technology Innovation Group, or TIG. This is mostly dominated by smart mobility and transit payments.
So think automated fare collection for metros, buses, that kind of thing.
Right. That and their data center solutions.
So let's talk about the moat. What makes them so hard to compete with?
The strategy is simple, really. Own the entire value chain. In transit payments, for instance, they don't just sell you a piece of software.
They're not just a vendor.
No. They own the end-to-end stack, the software, the IP, the proprietary hardware designed for the validators. They even manage the manufacturing process, which they outsource to places like Malaysia and India.
And owning that whole process, that gives them the edge.
It's the key differentiator. It means better margins because they're not relying on third parties, and much higher win rates because they can offer one single integrated solution.
And they're seeing the results. Management said they're winning most of the big Indian transaction banking deals.
Which just shows that product superiority. And that strategy is clearly working. I mean, the first half of FY26 was just stellar for them. They added 35 new customer logos in 6 months.
That's a record for them, right?
A record.
Right.
It's strong validation for what they're offering across both banking and TIG.
All right, let's shift gears to the financials, starting with the income statement or the P&L.
Top-line growth continues to be rapid. In Q1 of FY26, revenue was up 29% year-on-year.
And that momentum carried through into Q2, so it's consistent.
Very consistent. And it wasn't just one market doing the heavy lifting. The banking segment grew 31% year-on-year in Q1. That's from executing on their existing order book and new go-lives in places like Sri Lanka and the Middle East.
Plus big project completions like that SBI Phase 1.
Exactly. And TIG wasn't far behind, posting a 25% year-on-year increase in Q1.
Which is pretty strong considering management said Q1 is usually a softer quarter for that business.
It is. It just reinforces how strong the demand is.
Okay, so let's talk profitability.
Right. Management's guidance band here is very clear. For EBITDA,
And just a reminder, that's
earnings before interest, tax, depreciation, and amortization.
Yeah.
You could think of it as the true operational profit. Their guidance for that is 20 to 22%.
got it. And for PAT.
For PAT, or profit, after tax and net earnings, they're guiding for 15 to 16%.
Okay, so in Q1, the numbers were, what, 68 crore for EBITDA and 51 crore for PAT.
Yep, so the margins were within that guided range, but definitely, on the lower end of it.
Which brings us to the big question. If revenue is surging at nearly 30%, why aren't the margins expanding more?
Because the pressure is deliberate.
Okay.
This is where their investment thesis gets really aggressive.
Meaning?
Management confirmed they are choosing to accept short-term margin pressure to go after long-term scale and market share. Just look at their sales expense.
What about it?
It saw a 70 to 80% step jump in the first half.
70 to 80%. Wow. Okay, that's a huge jump.
It's enormous. They're adding capacity aggressively. 6 new sales specialists in Europe alone, plus new teams in North Asia and Africa.
Okay, but intentional short-term margin pressure can sometimes be a way to cover up just, overspending. What's the reassurance here?
The reassurance is that it's tied directly to the strategy. They know they're planting seeds in difficult new markets like Europe, where the sales cycle is long, the return is delayed, but they're building that local presence now to create a flywheel effect in about 4 or 5 quarters.
And they're also spending a lot on R&D, right?
A lot, around 9.2% of revenue in Q1. They're projected to spend over 120 crore on R&D for the full year.
So it's about prioritizing global market entry and product quality over showing peak margins today.
Exactly. And you also have to factor in the seasonality. The TIG business is always stronger in the second half, so margins should naturally improve in Q3 and Q4.
Right. So the expectation is for the full year, the margins will look healthier. But this cost base is a very deliberate upfront choice. Now let's move to the underlying financial health. For any investor looking at a high-growth tech company, cash flow quality is, well, it's everything.
It really is. And the first half of FY26 saw negative operating cash flow, which on the surface can look pretty alarming.
Right.
But it needs context. Management was very clear that negative H1 cash flow is normal for their business model.
And why is that?
It's because their revenue realization is tied to these very long project life cycles. We're talking 12 to 14 months for a client to go live.
So they book the revenue today, but they don't actually get the cash from milestone billing until a year later when the platform is deployed. That's a serious lag.
A very serious lag. So the accounting, the PAT, looks good right away. But the actual cash in the bank, the operating cash flow, trails significantly until the second half of the year.
When all those collections start coming in.
Exactly. And historically, their annual cash conversion is excellent. They turn 75 to 90% of their EBITDA into cash by the end of the year. You have to look at the full annual cycle, not just an H1 snapshot.
That delayed collection that points right to receivables, how are they managing that?
They're actually improving. Their DSOs, or Day Sales Outstanding, improved to about 100 days in Q2. That's down from 110 days the previous year.
So that 10-day improvement shows they're actively managing that working capital stress.
They are. And looking at physical investments, their CapEx, or capital expenditure, is planned at about 40 to 50 crore over the next 2 fiscal years.
And that's going towards?
It's dedicated to scaling up their internal manufacturing capacity for the TIG business. Again, supporting that moat to get better margins down the line.
Okay, and finally, what about the order book? How's the revenue visibility?
It's excellent. The order book is over 1,500 crore, and management is confident that at least 80% of that is executable over the next 5 to 6 quarters.
That's a huge runway for growth. All right, so for our efficiency check, we don't have explicit historical ROE or ROCE data in the transcripts to benchmark against.
Right, so that's return on equity or profit per rupee of shareholder investment and return on capital employed, which is the efficiency of all capital used.
So since we can't benchmark, let's analyze the structural choices they're making to maximize those returns instead.
We can assess the quality of their capital deployment. And what really stands out is their R&D strategy.
How so?
Unlike a lot of Indian tech companies that put all their R&D in one big, cost-efficient offshore center, AurionPro is very geographically distributed. They have centers in Singapore, Istanbul, London.
That seems counterintuitive. Why pick high-cost locations for R&D?
Because they're not optimizing for cheap labor. They're optimizing for specialized, high-caliber talent that exists in these global Fintech ecosystems. They argue that this choice, while it does increase their gross spending, results in a much higher quality product and gives them a competitive edge that attracts the best people.
So it's a long-term efficiency play, a higher cost today for a bigger return later.
Precisely. And another fascinating efficiency metric is their tax rate.
Their ETR, or effective tax rate.
Yes. In Q1, it was around 18 to 19%, which is way lower than the standard 25% corporate rate in India.
And that's because?
It's a direct result of their global product-focused model. The intellectual property, the IP, resides mostly in lower tax places like Singapore and Dubai. This lets them claim tax relief against their big R&D investments in those regions, and that keeps the ETR low.
So it's a very conscious design choice. They're building a global tech company, and that means optimizing the structure for both tax efficiency and product quality right from the start. Looking ahead then to the second half of FY26 and beyond, management laid out 3 core investment areas that really define their strategy.
They did. First is building out their enterprise AI stack. They're focused on what they call the super hard problem, which is turning AI models into actual production value for clients.
Model to production.
Right. Second is the push toward AI native applications. This means building brand new products with AI embedded from day one.
So new loan origination systems, new loan management, a bigger trade finance offering.
All of that. And the third imperative is just massive global scaling. They've poured money into Europe to get that sales flywheel going. They're expanding in North Asia and Africa. And they're sticking with a smart partnership approach in the U.S. with giants like Visa and MasterCard.
And the TIG segment, that momentum is continuing.
They've had huge strategic wins. Mumbai Metro, Chennai Metro, Delhi Metro, and a major transit deal with MasterCard in Egypt. Management sees transit payments as a primary global growth engine.
And the data center business.
That's about a third of TIG, and it's still growing at a robust 35 to 50% annually.
Okay, that's the growth plan. Now let's talk about the trade-offs. What are the explicit risks we need to be watching?
The primary red flag is sustained margin pressure and cost volatility. This is an explicit risk management has confirmed.
That 70 to 80% jump in sales capacity.
Exactly. That and the high R&D spend. It's a massive ongoing cost that will absorb any short-term operating leverage. You have to assume margins will stay at the lower end of that guidance band for a while.
Okay, risk number 2.
Sales cycle risk. The returns on those big investments in places like Europe are subject to really long 12 to 18-month sales cycles.
So the benefit from that huge upfront expense is delayed. It requires a lot of patience.
A lot of patience and discipline. And finally, there's the persistent execution risk tied to their cash flow. That 12 to 14-month lead time for billing means any significant project delay could immediately hit their year-end cash targets and strain working capital.
Okay, so let's synthesize all of this. It sounds like a high-risk, high-reward profile.
That's a perfect way to put it. And it's all driven by these very deep strategic choices.
Let's summarize the 3 biggest positives, the upside.
First, sustained nonlinear growth. Consistent 30+% year-on-year growth for 4 years is just an anomaly in the Indian tech sector. It proves they've picked the right products and the right markets.
Second,
Product and AI leadership. The deep investment in their proprietary AI stack and those dedicated R&D labs, it positions them perfectly for the next wave of fintech. They're building a real technological edge.
and third,
A strong structural moat. Owning that entire value chain software, hardware, IP in hot segments like transaction banking and transit payments. That gives them protection, drives high win rates, and it creates a clear path to margin expansion as they scale.
Okay, now for the other side. The 3 most significant negatives, the risk factors.
First has to be that short-term margin volatility. Management is telling you directly that margins will be under pressure because of these aggressive investments. It's a drag on current profitability.
Second,
High working capital needs. The long project cycles and seasonality mean you get negative cash flow in the first half and high receivables. It puts a lot of stress on cash management every year.
and the third risk factor.
Delayed return on global expansion. The returns from big investments in crucial markets like Europe are tied to those long, slow sales cycles. It means the operating leverage from those new teams is significantly delayed.
So here's the final thought we want to leave you with. The key tension here is that balance between the aggressive spending for growth and maintaining that margin guidance. Will the huge R&D spend solidify their global advantage fast enough to accelerate revenue and actually justify this elevated short-term cost base?
The rate of sales conversion in Europe and the speed of their AI implementation. That's what will dictate the trajectory from here.
And if this detailed fundamental analysis of AurionPro Solutions added any value to your understanding today, we'd kindly ask you to support us.
Please take a moment right now to like, share, and subscribe.
And definitely hit that bell icon for notifications.
We appreciate you engaging with us on this deep dive.
We'll see you on the next one.